Hi, this is Professor Higgins, and welcome to week 4 of our business organizations lectures. Tonight we're going to talk about general partnerships. We will be talking about several different types of partnerships, but I just want you to get general partnership in your brain first. You're going to have, first you have sole proprietorship, and now we're going to lay on top of sole proprietorship general partnership. So, or not general partnership, I'm sorry. Yeah, general partnerships. Okay. At first, I want to explain there is a commission of attorneys and judges, and they made up a national conference of commissioners on uniform state laws. And what they do is they get together and they think about all the different types of laws, and their purpose is to promote commerce across the United States. So as you know, laws in every state are different. And so in order to promote commerce across the United States, we have to have laws that are the same across the United States. Well, not to infringe on states' rights, but states still have the final say on how they want to handle each of these things. But this commission gets together and they research and they discuss with attorneys all over the country, and they come up with rules or proposals, and they make these uniform rules or these uniform laws. Then each state has the right to adopt them all, to not adopt any of them, to modify some and keep some. It's up to each state. Now, the first time they got together was in 1914, I believe. Let me double check. Yeah, 1914. And they came up with the Uniform Partnership Act in order to regulate partnerships. This stood for a good 50 years before there were any problems. But after about 50 or 60 and then 70 years, it began to become a little bit outdated. And so they all got together, or not the same folks, but a new set of attorneys, I think some accountants, some scholars, people in business that have the best minds in the country. They get together and they came up with, wait for it, another act with an even more exciting name. It used to be the Uniform Partnership Act, and then they came up with the name Revised Uniform Partnership Act, which we now just refer to as RUPA, R-U-P-A. So they came up with this in 1996, 1997, I think it was finally adopted, and the United States, Florida adopted this in its entirety. So for all of these rules that are in RUPA, what Florida did was the legislature adopted them all and gave them Florida statutes. So there's numbers that go along with them that are actually in our Florida statutes. Now, you won't be required to memorize or know the actual numbers of any of these rules, but you will be required to know the rules and what they mean. So, let's see. Their partnerships are regulated by Florida statute. And where did we get the Florida statute? We got it from the Revised Uniform Partnership Act, which is called the RUPA. And having a partnership agreement to form a partnership is not required. You don't have to have one by law, and that means you don't have to file one. You don't have to write it down. It can be orally. It can be in writing, which I far prefer. If someone is going to go into a partnership, they need to write down as much as they can, because partnerships are not very popular. At one time, they were extremely popular, but they're not anymore, and it's because partners tend to, well, I'll just say it, they tend to fuss and fight. They have arguments, they have disputes, and because they're not required to do a partnership agreement and file it, then a lot of times they don't. And so for that reason, there are fewer partnerships than sole proprietors in the United States. And there are fewer partnerships than even corporations. So let's go ahead and jump into this partnership phase of our lives here for this week. A partnership is a voluntary association of two or more people to carry on as co-owners of a business for the purpose of making a profit. Okay, now all of our business entities, I think I might have mentioned this before, are to make a profit. Because if you want to make a nonprofit business, you will have to make a corporation. And so we will talk about that after the midterm. So all partnerships are created for profit. Now I'm going to go through each of the terms of this definition so that you'll know exactly what we mean when I say a general partnership. A general partnership is a voluntary association which can be in writing. It can be an oral partnership. I can say, hey, would you like to join a partnership with me? Let's form one and let's make a profit by doing whatever. Or it can just be an implied partnership or voluntary association. What happens sometimes, you have a sole proprietor, that sole proprietor dies, leaves two children, those two children carry on the sole proprietorship. Now we know from last week that those children can't inherit the sole proprietorship, so what they have effectively done is they have, by implied voluntary association, created a partnership. And in order to make sure that they have a partnership, if we were looking at their relationship as they are carrying on the business of their parent, we would look for the following things as well. There would have to be two or more individuals. And when I say two or more, because if it was only one, that would be a sole proprietor. And even if a sole proprietor died and the only child carried on the sole proprietorship, that would be a new sole proprietorship. That's not the same, that he's not inheriting his father's sole proprietorship. The old one dies and then the next one starts. Okay, number 3, people. And when I say people, I'm talking about individuals, either natural individuals who are human beings with blood and bones, or artificial individuals, which are, corporations or businesses. A limited liability company can be a partner with a corporation, and they can join together and form a partnership to maybe provide food and beverage for the Super Bowl this year. We'll talk about that later, but I just want you to know it doesn't have to be 2 human beings that form partnerships. And it can be 10. All right. The people that are the individuals that form the partnership are co-owners. That means one is not an employer and one is not an owner. They are both co-owners, or all 3 of them are co-owners, or all 10. Everyone co-owns. The partners all have an ownership interest, and they can all participate in management and share in the profits and the losses. So when you start thinking of 2 people sharing in the management, it can be a little bit tricky. Much trickier than when you're dealing with the sole proprietor. What if you have 10 partners? Now you've really got a lot of people that have the reins and have the control and are trying to get along and do things. So partnerships are sort of a bevy of dispute. A lot of partnerships just crash and burn because people just can't get along, or they haven't thought things through really well in their partnership agreement to prevent disputes. Number 5, business. Every trade, every business can be a partnership. But what we find is that generally the businesses that like partnerships are partnerships like real estate, financial businesses like to enter into partnerships. They like to be part of partnerships, and insurance companies. So the most common is the real estate. Their partnerships, they are 46% of the partnerships. So when I think of a partnership, I think of real estate companies. And then again, they have to be number 6, for profit. Or I guess I should say the expectation of profit. As long as they're not a non-for-profit business, they are fine to be a partnership. Partnership capital is the next thing that your textbook talks about. And partnership capital is property, money, or service. So the property or money or the service is contributed by one of the partners. Each of the partners brings something for the purpose of carrying on business in the partnership. The partnership property is anything that the partnership owns. It consists of the partnership capital that they start with, and then in addition to that, it's any property that the partnership creates in the practice of its business. The partnership agreement is an agreement by 2 or more parties to do business together as a partnership. It can be oral, or in writing, much better. And RUPA, our Revised Uniform Partnership Act, that has been adopted by the state of Florida. RUPA acts as the default. If anything is left out of the partnership agreement, then RUPA has the answer. This is to say that if you get into a dispute because there's something that hasn't been determined by or regulated or mandated by the partnership agreement, then RUPA applies, and you don't need to go to court to find that out, because the court's just going to say, hey, talk to the RUPA. RUPA is going to apply. So make sure if you are starting a partnership, that you always know what the Revised Uniform Partnership Act says about any given issue, because that's what's going to apply to you. And especially if there's something in RUPA that you don't like, then you want to make sure that in your partnership agreement you have handled that differently, because your partnership agreement is the law of your business. So as long as it's in your partnership agreement, that's fine. But if it's not, then we're going to go look at RUPA, and RUPA will mandate. Okay, the formation of the partnership. Everything that we talked about setting up, that long list of stuff that I gave you for sole proprietorship, that all applies here. The licensing, the local business tax receipts, all those state, federal taxes and stuff, unemployment compensation, blah, blah, blah. All that stuff applies. Plus, a partnership is formed by the agreement of the partners. The partners themselves may want to formalize, and they should formalize in writing, their agreement in either of the following ways. Number 1, a contract. A contract that we would call a partnership agreement, which may either be expressed or implied, always expressed, always in writing. If you are involved in setting up a partnership, you always want to have a written partnership agreement. However, sometimes people come in and they're having a dispute and they talk to the attorney, and the attorney is like, well, I've looked at everything and this business seems to be operating as a partnership, and the partnership agreement was implied when their mother died and the 2 sisters took over the beauty shop, that type of thing. Number 2, a partnership may file a partnership registration with the Department of State for $50. It must be signed by at least 2 partners, and copies have to be given to every partner listed if there's more than 2 partners, then everybody who is listed as a partner gets a copy of this thing. The reason that you would want to file a partnership registration is in case down the road, 8 months, 9 months, 10 months later, something goes wrong and somebody doesn't like what somebody else did, and then one of the partners says, hey, we weren't in a partnership. I'm not responsible for what he did. Okay. Now, we have studied, you and I, the law of agency, and we know that a partner acts as an agent for other partners when he is in the course and scope of his business. So we would be perfectly willing to argue that in court, but we wouldn't have to if those folks way in the beginning when they were setting up their partnership, if they had filed or registered their partnership with the partnership registration with the Department of State. So the Secretary of State will have that $50, run down to SunBiz, get it done. If they don't formalize their agreement or file the optional partnership registration, oftentimes disputes arise as to whether the partnership actually existed. So this goes a long way, and the Florida legislature codified prior court opinions and set forth criteria to look at a business entity to see if they thought it was a partnership agreement. And so we had all this case law, and then RUPA came along and made that made it law. So now we have Florida statutes on it. So one of the things, and I've got the Florida statute here, when you're faced with a question of whether a partnership existed, the Florida state statute is 620.8202. And don't even have to memorize that because you can always look it up and see what it says. But these are the things that it asks. How did they hold title to property? If the property, whether it's real estate or personal property, if the title is held jointly, that's evidence of a partnership. What was the designation of the entity? Did they call themselves Johnson Partnership or Motorcycles Partnership? Then it's probably a partnership. The court is going to find that that is more likely a partnership. How were the profits shared? A sharing of profits is a prima facie case. That means that, or there's prima facie evidence, that there's darn good evidence, basically, that there's a partnership. But be careful. Be careful to consider, is it for payment of a debt or wages or rent or interest on a loan? Florida courts have these 3 things: how they hold title, what the designation of the entity is, and how were the profits shared. And then they have added 2 more things. What was the amount of the activity? Did they purchase a piece of real estate for $5,000 together one time? If that happened, it's probably not a partnership. But did they purchase 20 different pieces of real estate for $5,000? And did they then begin to put little cabins on them around a lake? And then did they begin to market those as Airbnbs? If you have an ongoing situation, then you probably do have a partnership. Let's see. And then the last thing is, how are the losses shared? Do they all share the losses? Probably a partnership. Does only one guy get hit with the losses? Maybe not a partnership. So all of those things show you a little more evidence, and you put all your partnership evidence over here, and things that don't prove that it's a partnership, and then that's how the court decides. All right. As to proper property, as to partnership property, Section 620.8203 in Florida statute says property acquired by the partnership is partnership property. Courts will also look at the following criteria if one partner is claiming that the property is personal as opposed to being partnership property. If I join a partnership with, let's say, my two brothers, I bring my pickup truck. My second brother, George, puts in $10,000, and my third brother agrees to do all the work of this partnership. Then the courts will look at that and decide what is partnership property. Number one, has it been used by the partnership in conducting business? Okay, so if I say, well, this is my pickup truck and it's not a partnership asset, and when we're dividing up at the end of our contract or at the end of our partnership, we want to quit being partners, and now they're saying that they want they each want a third of my pickup truck, and I'm saying no, it's personal property. The court is going to look at me and say, has it been used by the partnership in conducting business? Well, let's pretend my brothers and I were running a landscaping business, and I said yes, the truck was being used. We did use it in the business to do landscaping. It hauled plants, and we hauled mulch and dirt and trash, and we hauled it off after cleaning up people's properties. The court's going to go, well, that sounds like partnership property. Has the partnership improved the property? Well, as a matter of fact, Your Honor, yeah, I got a crack in my windshield, and so the partnership paid to have the windshield fixed, and then we also got it repainted because we had Higgins landscaping painted on the side of it. The court says, that sounds like partnership property. Is the property closely related to the business operations? Well, I tell you, we do sell some of our plants online, so technically it's an online business, Your Honor, and we don't need a pickup truck. And then my other brother gets in and says, well, yes, we do. She just told you how we hauled plants in it and mulch and dirt and stuff. The court's going to say, sounds pretty related to your business. Is the title acquired in the partnership name? And I'm going to say no. The pickup truck is in my name. Okay, there's one bit of evidence now for it to still be a personal property. But if the partnership had been on the title, that would be yet more evidence that it was partnership property. Is the property listed as an asset in the partnership books? Well, it probably is, because I brought it in as partnership capital and it was my contribution. So that goes to, yep, it's partnership property. Number 6, the partnership pays taxes, insurance, maintenance costs, and other expenses. And yeah, because I just admitted that they replaced the window and they did the tire, they fixed the tire, and yeah, they did pay for the tax, the license plate on the back of it. So the court's probably going to find that even though I'm an excellent attorney and I argued as hard as I could that it is not personal property, it's partnership property. All right, a partner's interest in the partnership. Unless the partnership agreement says otherwise, now remember, anything that you don't like that RUPA says, you can change it in your partnership agreement. But if it doesn't, if your partnership agreement is silent, then each partner equally shares in the profits and losses. Thus, the rights to these profits and losses may be assigned, but the assignee will not be entitled to participate in management, just the collection of profits. All right. This means that, let's go back to my brothers and I. Let's say I put in 10%, and then my second brother puts in 40%. And my third brother puts in 50% of all of our contributions initially. Then we make profits. Let's say we make $100,000 in the first year. If it doesn't say anything in our partnership agreement about how much we each should get, RUPA mandates that we split it equally, that we would all get 33 $1,333.33, and somebody would get 34 cents. All of that work. Now, the guy that put in 50% and the guy that put in 40%, they're not going to be very happy with only getting 33 and a third percent back out. But I'll be pretty happy. I only put in 10% of the money, and now look at me. I'm walking out with $33,000. So be very careful. Rupa says if it's a general partnership, all of the general partners are going to share the profits equally unless the partnership agreement says otherwise. And then this part about the assignee, that means that if I decide I don't want to be part of this business anymore, and I want my son to be part of the business, then I cannot give him my partnership interest. The only thing I can do is assign him profits. But he cannot have control. You know how the partners all share control of the partnership? He cannot have any control over decision making, because the only thing I can give him is I can assign my share of the profits to him. All right, let's look at the partnership's right to participate in management, since we're here and my son doesn't have any of those rights. Unless the partnership agreement says otherwise, Rupa will control. And Rupa says all partners have equal rights to participate in the management of the partnership. Now, the partnership, we can get together and agree. Let's say one of my brothers is just a super green thumb growing guy. He can grow plants like crazy. We can make him the managing partner, and he can run the whole deal. He can even bring his expertise into the partnership as his capital contribution. The only thing is we have to make sure that when I bring my truck and my other brother brings his money and then my other brother brings his expertise, that expertise is valued. The truck has to, we have to assign a value to that. We assign a value to the brother that brings the money in, which is much easier to do. And then we have to assign value to the brother's expertise that the third brother brings in. Let's see. What if we want to have a new partner? According to Rupa, in order to bring on a new partner, 100% of the partners have to agree. So you guys might know this, but I have 3 brothers. I'm in business right now with the 2 brothers, and we're doing the landscaping gig. And then my other brother says, hey, I didn't think you guys would be making any money. You made $100,000 last year. Let me in. Well, in order to bring him in, we have to agree 100%. It has to be unanimous, or Rupa says, nope, you cannot add any additional partners. Now, you can always change that in your partnership agreement for your partnership, but if you have a partnership that is silent as to adding new partners, then Rupa applies. Or if you have a partnership agreement that, well, if it doesn't say anything, or if you don't have a partnership agreement, then all the other partners have to agree to have the 4th partner come in. Relations among partners. And I don't mean like brother-sister relations. I'm talking about what kind of duties and obligations are owed to each other. Rupa says that no matter what the partnership agreement states, partners always have the following duties, which are going to be owed to each other. A duty of loyalty, first. A duty of care, you have to be careful. Duty of good faith. And then additionally, partners owe each other a fiduciary duty. That means they are bound by law to be honest about all financial matters. So partners owe a financial duty to each other. I'm just trying to read my notes here. Must be honest with each other regarding finances. Okay, basically that's what I said. Good. And then the fifth one we know already because we've studied the law of agency. According to Florida Statute 620, 8301, partners are agents of the partnership by act of law. So, boom, there you go. Thus, all of any actions by other partners are going to are binding, and they bind the entire partnership. Partners may be jointly and severally liable to each other. Okay, this statement is big. I'm going to read it again. Partners may be jointly and severally liable to each other. That means that if the partnership gets sued, the plaintiff who is going to sue the defendant partnership can pick which of the partners they want to sue, and then that partner is responsible for whatever the partnership debts were, or whatever the case and controversy was about, and then that partner has to turn around and sue the partners so that he can get indemnification or remuneration, is what we call it, when one partner ends up paying for the acts of the others. Remember the principal agent theory? So vicarious liability, joint and severally liable to each other. And this is because, and I just want to stop and talk about this plaintiff for a minute. The plaintiff's name, I like to call him IP3. And he's not a robot. He's very much alive. He is the innocent third party. And the law of Florida, or the law of business, loves IP3. I mean, they love the innocent third party. We want business to be robust, and we want our economy to thrive and be bustling. And the United States loves the small businessman. So we are always protecting the innocent third party anytime there is a business dispute. That means if a business, and in our case tonight we're talking about general partnerships, if our general partnership causes damage or costs money to an innocent third party, then it doesn't matter who in the partnership is actually responsible. The partnership is going to be responsible and make the innocent third party whole. So if the partnership doesn't have the money in the bank or doesn't have the assets to pay the damages of innocent third party can come after any or all of the partners that he wants to. And generally, I3P's attorney says we'll take them all down, we'll sue them all, and then we'll just see where the money comes from. They like to go after the deepest pockets. So if there is one partner that is rich, that has a lot of money, sometimes they won't even waste their time on the poor partners. They will go after that innocent third party's attorney, knows to go after the deep pockets. They'll get their cash. Innocent third party goes off, and then the partner is left, the rich partner is left to try to get money from the other partners or the partnership. Okay. Now, number 7, partners are not entitled to remuneration unless the partnership agreement says otherwise, which means that it can. The partnership agreement can say otherwise. Unless the partnership agreement says otherwise, a partner is not entitled to payment for services rendered on the behalf of the partnership. So, let's say we're working at the landscaping business, and I go by and I go, oh my gosh, this place looks terrible. We're a landscaping business. I run home and I get my lawnmower and I start mowing. And I mow, it's 5 acres, okay, just pretend. And I jump on actually all I have is a push mower. So for 5 acres, I'm out there pushing my lawnmower, and I'm tired. I'm tired after that. So what do? I stroke out, I write up a bill, and I send it to my brothers, and I say, hey, I'm the sister, you're the brothers, you should be taking care of this. And so because I had to do it, I'm going to bill you guys Well, look at this. Number 7, partners are not entitled to remuneration. So I can't bill my brothers or my partners for my services. I'm just a partner, and I was doing it for the good of the partnership. All right. Relation between partnerships and third parties. Okay, now we're going to get serious about I3P here, innocent third party. Every partner has the authority to bind the partnership when dealing with third parties. If they are acting, this is a big if they are acting within the course and scope of their business. So, if one of my brothers, one of my partners, promises to deliver 4 oak trees to an innocent third party, and he sells them to the innocent third party for $10 a piece, then we have to honor that. We have to make sure that those 4 big, hopefully they're just little twigs, but probably not. They're probably big, heavy oak trees, and for $10 a piece or $10, whatever the partner promised them, then we are bound by that. Now, if one of my knucklehead brothers decides that he found a really good deal on shampoo and it will make us all better salespeople if we start using that shampoo, and he goes and he buys 77 gallons of shampoo for us to use in our hair so that we'll be more presentable when we work on our landscaping jobs, that's probably not within the course and scope of our business. I hate to brag, I am a pretty good attorney in the courtroom, but I think I could easily argue that, no, he's on the hook for that shampoo. The partnership's not going to pay for that. All right. Rupa was concerned that innocent partners like myself might be bound by the rogue acts of their partners, like my brother who went shampoo shopping and found this really good deal. Therefore, the statute provided an opportunity for partnerships to file an optional document to put the public on notice as to which partners may bind the partnership and what authority is either granted or, more importantly, denied that rogue partner. All right. Section 620, 8303, talks about something called a Statement of Partnership Authority. This is a document that a partnership can file with the state of Florida. It's a simple document, and for $25 you can say, Professor Higgins is the only person who can make purchases for the partnership, and her partnership purchasing power is only in regards to landscape equipment, plants, trees, or other foliage, and we can file that, and we can even say rogue brother number 3 is not allowed to make any purchases on behalf of the partnership. Okay? Boom, for $25, now we've cut that guy off and he's not going to be doing anything crazy anymore. We can take the rogueness right out of our business. There is also another simple document that can be filed by a partner or another interested party contradicting the information in that statement of partnership authority. It can be my brother saying, yes, I can purchase, I am a partner and I can purchase shampoo and any other beauty products that I deem necessary. And this just shows you that Rupa was already thinking partners are going to get into disputes. So we've got to give the public a way to know about these things. If you see something like that, then you want to stay away from that business because it sounds like they're having issues. What happens if a person joins an existing partnership that already has incurred a liability. Okay, so let's say the four of us knuckleheads are running our landscaping business, and then one of my brothers says, you know what, maybe we need to bring in somebody who has a little bit of landscaping knowledge and business knowledge that can help us. And so we bring in this one, we all agree to it, it's unanimous, we all bring in this other person to be our partner. And this person, hopefully we're thinking he's got business or she's got business savvy to kind of keep us all under control and to help us make money instead of fighting so much. That joining partner, if we've gotten ourselves in trouble and we have liability or there's litigation going on, that partner that comes in, he or she is protected from that part of that lawsuit coming after them personally. We said before that partners have exposure to unlimited personal liability, or we will say that. We'll be talking about in a bit. And that person, the new person that comes on, he's not liable for anything personally unless he was part of it at the time the debt occurred. If there was an issue, then if a debt occurred or there was a case in controversy that came up, the date of the incident, if he wasn't a partner at that time, then he's not liable for that. What happens if a member of a partnership leaves and there is an existing liability? Okay, so let's go back to the four of us, and my one brother goes out and he buys all this shampoo, and then the courts we take him to court and we say, we're not paying that. And even though I'm such a great attorney, somehow it was a miracle, but I lost. And the partnership is going to be liable to the innocent third party who sold the shampoo to my idiot brother. So one of my other brothers takes off and leaves. He's like, oh, I see what's going to happen. The court's going to make us all pay. I'm out. I don't want to be part of this partnership anymore. And he tries to run. Well, he can leave the partnership, but he is still liable. He can't run away from the innocent third party. The innocent third party is going to get their money, whether they get it from me or from all of us or whatever. But if maybe it's the rich brother that runs because he's the only one with money and he knows that the innocent third party's attorney is going to come after him, then boom, he's still liable, even though he leaves because he was part of the partnership at the time the incident occurred. Okay. We're going to move right along here and talk about dissociation. Dissociation, under the old law, under UPA, if one partner left, the whole thing died. The whole partnership was gone. It was over. RUPA completely changed that. They stated that if dissociation occurs, they kind of invented this term for business, for partnerships. If one of the partners leaves, they have a choice. You can either dissolve the whole partnership, or you can just say, well, we've had one partner that dissociated, and once that partner dissociates, the partnership can still run. So when you have a partner who is either withdrawn or he was expelled from the partnership, if he went bankrupt, or if he died or became incompetent, then the whole partnership could either shut down, and that is the effect of dissociation. When that one partner dissociates and he's no longer part of the partnership has the two options. One, it can terminate and begin winding up all of its affairs, or it can, the partner can buy out the partnership interest. The partnership can buy out the partnership interest of the dissociating partner that took off, and then continue the operations of the partnership without the dissociated partner. The dissolving partner, when he leaves, he must distribute the assets, pay debts. No, the partnership, I'm sorry. I've misread this. If they decide, like one partner takes off, then the partnership can say, okay, we're going to dissolve everything. They dissolve it by winding up their affairs. And the first thing that they do is they distribute, and they pay their debts. Then they distribute their assets, and then they settle disputes. The dissolving partnership also has the option of filing a statement for $25 again, a statement of dissolution, which acts to cancel a statement of partnership authority. So remember, we had the statement of partnership authority saying that I could that I was the one that was going to make all the purchases. Let's say I'm the one that's taking off and I'm dissociating. I don't want to be involved with my brothers anymore. So they should do a statement of dissolution. Well, if we dissolved, they would do a statement of dissolution that says no one has any rights to act as a partner. This partnership is over. Statement of dissolution. Or they could say, good riddance, our sister's gone, the three of us can run this thing a lot better. They buy out my partnership interest and continue operating the partnership. Generally, the dissociated partner's interest is purchased for a price usually paid for by a life insurance policy. And a lot of partnerships have life insurance policies on each of the partners. So they can just, if that partnership dies, then they have money, basically, and they can give that money to the spouse to buy out that partner's partnership interest. The partnership interest may elect to file a statement of dissociation. This says, our sister dissociated from us. We're letting you know that she no longer has any rights to act as a partner in our partnership. This will limit the partnership's responsibility for the acts of the dissociated partner, that would be me, for up to 1 year after the partner leaves. Otherwise, I could go out, and the law is going to protect innocent third party. I could go out to innocent third party, pretend like I was still a partner, and I could keep those partners, my brothers, on the hook for anything that I promised to innocent third party. Now, of course, innocent third party would sue the partnership. He would probably sue the richest one, the one rich brother that we have. Rich brother would have to pay it for the partnership, and then he would come after me hard. So I'm not going to do that, but I'm just saying that's how the law operates. All right. That's a lot. So let's move now. The last two things I want to do is discuss the advantages and disadvantages of having a partnership. And there's going to be, I'm just going to tell you now, there's a lot more disadvantages to a partnership in the state of Florida, and really all over the country, than there are advantages. So the advantages will be pretty quick, and then I'll just go through the disadvantages with you. It's going to take a little bit longer. All right. Participation and flexibility of management. All the partners get to participate in the management, and they can act freely on behalf of the partnership, really with minimum restrictions. So that's nice. Anytime I think you have more than one head making decisions, and anytime there's decision making, I think it's better to have more views, and then the good views will bubble up to the top. So if you have a sole proprietor who's just one guy making decisions all the time, you don't have that give and take and the different perspectives. And the more perspectives there are, I think, better. Sometimes you can get to where there's too many, and it becomes very counterproductive. But in the case of 2 or 3, probably good. Minimal formalities and regulatory reporting. There really is no formal formation required in Florida. All the forms that are, this is going to sound funny, all the forms that there are, I was going to say all the forms that are required are optional. All the forms that are available are optional. The forms are really for the good of the partnership, and the state doesn't really make money on it. Number 3, the low cost of organization. The optional forms that there are like $25, $50 for the big one, the registration, and then about $25 for the other ones. No required filing fees. They're relatively cheap to run a general partnership. There are income tax benefits. Partnerships are taxed the same way as a SP, a sole proprietor, in that profits and losses go on the individual partner's tax return. It passes through taxation of Schedule K. You won't need to know that, but just know that a partner's profits that they get, their chunk of the profits, go on their personal income tax return. But if they want to, partners can check the box, which basically means they can elect to be taxed as a corporation if they want to, and they file an 8832. But once a partnership elects to be taxed as a partnership, they cannot change back for 5 years. And then number 5 advantage, diversified capital resources. More people to draw money from. So if I'm a sole proprietor, I'm the only guy that, I have to dig in my own pockets to come up with more money. The only way I can get more money really is to work harder. If you are a partner, you can talk to each other. It's a lot easier to come up with $10,000 if there's 5 partners, then everybody can throw in $2,000 and you've got it, rather than if you're a sole proprietor and you have to come up with all $10,000 yourself. Or you can always, let's talk about it. Maybe we bring on some additional partners and we get capital out of them. All right, the disadvantages. Unlimited liability exposure of the partners. This is huge. This makes our little legal hearts flutter. We don't like this. Unlimited personal liability exposure of the partners. There is joint and several liability. Thus, one partner can be sued and is liable for the foolish acts of another partner or the partnership. The wealthier partners are more at risk because it's a lot easier to sue someone that's wealthy and get money than to sue someone who is poor and doesn't have any money and get money. So the law protects innocent third party. You can sue the rich partner, and then innocent third party is happily going on his way, and it may take 2 or 3 years before the rich partner is able to get his money out of the poor partner. Number 2, a loose structure of management. Is the majority rule best for you? What happens if there's an even number of partners and they can't come up with a good resolution? There's no vote that throws someone over. There's not even a rule that you have to have a written partnership agreement. So loose structure of management, disadvantage. Difficulty with transferability. You cannot sell your interest in the partnership without the consent of all the other partners. So it's not as simple as selling a share of stock. If, let's say, I have 100 shares of Disney and Disney starts making bad decisions or doing things I don't like, I can just sell those stocks and I'm out. It takes me 24 hours or 48 hours at the longest, I think. I can just sell those stocks and I'm out. I'm not an owner of Disney anymore. If I'm a partner, then not only do I have to find a buyer for my interest, I have to get it approved by every single other partner. And if those guys are angry at me, then they may not, or they may, but they may not agree to the person that I want to sell my interest in. Because being partners with somebody is it's kind of an intimate deal. It's someone has control over your finances or a piece of your finances, and that's very near and dear to people's hearts. All right, limited ability to raise capital. Okay, it's easier to raise capital in a partnership than a sole proprietorship, but it's still not that easy. You still are depending on the partners that currently exist, and generally, if you need more money, then it's going to have to come from one of those partners or just bringing on new partners, which is not always an easy task either. There are legal and organizational expenses. Everything that we discussed for the sole proprietor, they have to spend money on that, plus the expense of the partnership agreement. And if you are going to have a partnership agreement, you really need to go to the expense to hire an attorney and an accountant and get a really good partnership agreement worked out among all the partners, and that's going to be probably at least $1,000. There are tax disadvantages. If you make additional income, then that means you're going to be in a higher tax bracket. All right. What goes into a partnership agreement? This is going to be really important. If it's left out, then we know RUPA applies. So whatever RUPA says is going to be the law of the business. However, if you are going to start a business or start a partnership, or you are going to help some people start a partnership, your law firm is, then I have a list of things here that I just want to make sure that you have in your partnership. Now, I could bring in some partnership agreements that I worked on for clients, books, like really thick partnership agreements. Excuse me. But I'm just going to go through the list of things here that I've got in your class notes and just try to tell you a little bit about them. Some don't need, like the name and address of all the partners. Doesn't need a whole lot of explanation, but you need the name and address of all the partners. You need the name of the partnership. You need the purpose of the partnership. You want to decide whether are you going to draft this broadly or very narrowly. Are we going to sell clothing, or are we going to sell women's two-piece swim outfits? It can be very tailored, very broad, or, pun intended, or very narrowly. Okay. The address and principal place of business, the address of the principal place of business, the term of the partnership agreement. It can be in perpetuity. If you leave that out, then RUPA says it is in perpetuity, which means forever. If you don't leave it out, then you have to state, if you can say I want it to be forever, or you can say I want it to be until the Super Bowl, till the end of the Super Bowl, or you can say I want it to be for 4.5 years. So however you want to limit the term, you can absolutely limit the term. Number 6, contribution of the partnership. Each partner is going to contribute to the partnership, and so you will have the valuation of the contributions made by each partner in your partnership agreement. Oops, getting confused here. Additional contributions required. Okay, in your partnership agreement, you should say, now, if at some point we need more money, here's how we're going to do it, so that everybody knows right up front when they sign this document how we're going to get more money. We might wait until we have $2,000 in our bank account, and then we're going to need more money. Or we might say every month, every partner is going to drop another $10,000 into the bank. It can be whatever you want. It can be based on time or event when you're going to have additional contributions. But you should have something that speaks to that or addresses that. Number 8, assets of the partnership. You have to list what all the partnership assets are, how they were valued, and the control of the assets and the distributions of those assets. All right, number 9, a goodwill evaluation, which is the value of the reputation of the partnership, is to be considered in the distribution of assets. And if so, explain the formula for valuation. A lot of times, a lot of different accountants have to get in and tell what they think the reputation is worth, the goodwill value. So that can be tricky, but it's better to be tricky right at the beginning and get it all down on paper. Number 10, liability. Explain liability among the partners and also liability to the third party. You want to put that in your partnership agreement. Number 11, distribution of profits and losses. Remember, if you don't have this in, RUPA is going to apply. The indemnity provision, the partners' agreement for indemnifying each other has to be in your agreement, your partnership agreement. 13, the duties of the partners. Be as specific as possible. List all of the duties for every single partner, and if someone has no duties, put that. 14, powers of partners and limitations on those powers. Self-explanatory. 15, compensation and benefits for partners, if any. Are you going to pay your partners? Are you going to give them a once-a-year percentage of the profits? Are you going to do it weekly? 16, provision for expenses of the partners. What about who's going to do the banking? What parties are going to be responsible for doing the banking? Who is allowed to take out loans for the partnership? Management and control. Set forth all policies specifically. If a managing partner is going to run the partnership, specify who it is, any compensation that they're going to get, and how they're going to be hired and terminated. Is this just going to be rotated among the partners? Are you going to have one person do it because they have all the experience? Or are you not going to have a partner manage it all? Is the partnership agreement, going to hire someone in the field of this business that is an expert and is going to be paid to manage it? 18, partnership accounting. All accounting methods and policies of the partnership need to be clearly laid out in the partnership agreement. Changes in partners. If new partners are going to be admitted, how is this going to occur? What if someone wants to leave or retire? Be sure to mention notice and valuation of assets in this section. How are you going to handle the death of a partner? How are you going to handle the sale or purchase of a partnership interest? Are you going to take out a life insurance policy on everybody? 22, are you going to arbitrate the differences? What law is going to apply? What route do you want to take? And who's going to do the arbitration? And if you're going to do mediation, is it binding? Termination, dissolution of a partnership, and winding up of the assets. What events are going to trigger termination? You need to expressly and clearly state the method of winding up. The partner that's left with the responsibility of winding up all these affairs really should be compensated. And so how much are you going to compensate that person? A safe way to do that is after you have paid all your debts and you have a certain amount of money left, you've sold your assets and you've paid your debts and you've got the chunk of cash that you're going to be distributing among the partners. Maybe that last partner who's going to have to do all this work takes 2% or 3% of whatever that is. And 24, the date of the agreement and the signature of all the partners must be on the partnership agreement. Now, the partnership agreement is not filed with the Secretary of State or anything. It's kept with the books and the records and all the important papers of the partnership, but it doesn't have to be filed or anything officially. And then partnership books. Section 620, 8403 Florida statute says that all partnership books must be maintained and all partners and their attorneys have the right to look at them and access them. All right. That is all I have on general partnerships. I know it sounds like quite a bit, but let's see. But that's all I have tonight. So if you have any questions or any comments about this, please shoot me an email. And it looks like I went over an hour. I was trying to keep it under an hour this evening, but I will do my best next week. All right. Thank you for coming. I will stop. You guys have a good night.